Picture a row of Tokyo office towers at night, every window glowing, every desk occupied. And on the streets below, men in dark suits rush for the last train, because taxis have a 3 hour wait. It's 1989, and Japan believes it has solved capitalism. Land around the Imperial Palace is worth more than all the land in California. Golf club memberships sell for the price of a house. And the world's largest banks, the top five all Japanese, confidently forecast a century of Japanese dominance. But beneath the neon, something else is building. A quiet pressure. A belief that markets only rise. A system where no one wants to be the one who breaks the illusion. Because inside Japan's greatest economic boom was the psychology that would eventually destroy it. And within a few years, the miracle that stunned the world would collapse under its own weight, sending Japan into a decades-long winter from which it has never fully returned. This is the story of how an economic miracle was created, and why it had to fall. In 1945, Japan was not a rising superpower. It was a nation broken. Factories lay in rubble. Rail lines were mangled steel. Output collapsed to a fraction of pre-war levels. Food was scarce. Fuel was rationed. And the idea of Japan becoming the world's second largest economy seemed impossible, almost absurd. But from ruin came clarity. Japan's leaders, political, industrial, and academic, agreed on one thing. The country would rebuild through production, heavy industry, manufacturing, exports. Not because it was glamorous, but because it was the only way out. Japan did not copy the American model. It built something else. A system that fused government direction with private enterprise. Bureaucrats from the Ministry of International Trade and Industry, MITI, quietly guided the economy. Which industries mattered, which companies could merge, which technologies should be licensed, and which imports should be restricted. It wasn't central planning, and it wasn't free markets. It was something in between, a philosophy built on stability, consensus, and long horizons. And for a nation traumatized by war, it felt comforting, predictable, safe. Japan's post-war generation shared a belief that became the engine of the miracle. Sacrifice today for a better tomorrow. Workers took lower wages in exchange for lifetime employment. Companies reinvested profits rather than distributing them. Banks prioritized national interest over short-term returns. And the public accepted it, because the alternative was national stagnation. The central tension emerges here. Could a system built on stability survive success? The 1960s transformed Japan from a follower to a contender. Toyota reinvented manufacturing with just-in-time production. Sony created products that captured the world's imagination. Companies learned to do what no one else could: build high-quality goods cheaply. Between 1955 and 1970, Japan's economy grew 9.6% per year, faster than any nation in modern history. A miracle. But also a momentum that became addictive. Japan's social contract worked because everyone believed the system protected them. Banks rescued struggling firms, companies protected workers, the government protected industries. Failures were contained, discreet, almost invisible. Bankruptcies were rare because they were seen as a national shame. Japan's strength, collective stability, hardened its cultural dogma. And beneath the growing GDP numbers, a psychological shift began. Success was no longer something to chase. It was something expected. When the 1970s oil crisis hit, Japan was vulnerable. It imported nearly all its energy. Yet the crisis strengthened Japan's resolve. Factories became more efficient. Cars became smaller and more fuel-friendly. Electronics became world-class. While the West fought inflation, Japan adapted. But adaptation has a cost. It convinced Japan that every crisis could be managed, controlled, scientifically engineered away. This belief, this confidence, would later set the stage for disaster. In 1985, the world's major economies wanted the US dollar weakened. American exports were suffering. Trade imbalances were soaring. The solution was the Plaza Accord, a coordinated effort to let the yen strengthen dramatically. And it did, violently. Within 2 years, the yen nearly doubled in value, threatening Japan's export machine, the backbone of its economy. Japan's response was predictable and catastrophic. To soften the blow, the Bank of Japan flooded the system with liquidity. Interest rates fell, credit expanded, banks loosened lending standards. And suddenly, Japan was awash with money, more money than it knew what to do with. Executives began buying land and stocks not because they were cheap, but because credit was easy and prices never seemed to fall. A subtle shift in national psychology took root. Growth was no longer earned, it was engineered. Culturally, land in Japan had always held symbolic weight. It was scarce, it was permanent, it was safe. Now it became collateral for infinite borrowing. Companies bought land because land prices went up, and prices went up because companies bought land. A perfect feedback loop rationally dissolved. One economist famously noted, "If current trends continue, the grounds of the Imperial Palace will be worth more than the entire state of California." It was absurd. Everyone knew it. But no one wanted to be the first to say it. By the late 80s, Japan appeared unstoppable. Half the world's top 10 banks were Japanese. Tokyo's stock market made up to 45% of global equity value. Young workers saw finance as the fastest path to status. Corporations competed for land as symbols of prestige. It didn't matter if property was useless for operations. Owning it signaled power. Across the country, three beliefs were universal. Land never falls, stocks never fall, Japan is different. This was not greed, not in the Western sense. It was faith. A collective belief that Japan's system, its discipline, and its unity made it immune to the volatility that plagued other nations. But immunity is an illusion. The higher Japan rose, the more fragile it became. By 1989, the Bank of Japan saw what was happening. Asset prices were untethered from reality. Lending was reckless, speculation was rampant. But raising rates carried a hidden risk. It meant admitting that the system could fail. Still, the central bank moved, quietly, incrementally. But even small moves were enough. The shock rippled instantly. In 1990, the Nikkei index collapsed. Not gradually, not in stages. Instead, it shattered, losing half of its value in 3 years. Real estate followed. The myth dissolved. Banks that had lent freely were suddenly sitting on mountains of bad loans. And for the first time in decades, Japan confronted a truth it had forgotten. Stability is fragile. Executives who had spent their entire careers believing in steady growth were now paralyzed. Admitting losses carried shame, so they didn't. Banks rolled over failing loans instead of writing them down. Companies avoided layoffs to preserve lifetime employment promises. The behaviors that once made Japan resilient now made it unable to adjust. Banks stopped lending, small businesses starved, investment dried up. The system had built to prevent collapse, but in doing so, it prevented recovery. Japan was entering a new era, one defined not by crisis but by stagnation. The lost decade had begun. Unlike the US in 2008, Japan did not experience a dramatic financial crash followed by a quick rebound. Its decline was glacial, predictable, relentless. GDP stagnated, deflation took hold, and wages flatlined. A generation of young workers entered adulthood with fewer prospects than their parents, a reversal unthinkable during the miracle years. Japan's leaders were caught in a mental trap. If they admitted the scale of the losses, trust would evaporate. If they ignored them, the economy would suffocate. They chose the second. Zombie banks, insolvent but kept alive, drifted through the 1990s. Zombie companies survived through evergreen loans. It wasn't corruption, it was fear. Fear of breaking the social contract. Fear of humiliation. Fear of confronting the final bill for the miracle years. Japan tried everything. Zero interest rates, massive public work spending, fiscal stimulus, bank bailouts, later quantitative easing. Each move stabilized the patient, but never cured the illness. The system needed a reset. The psychology of risk needed reinvention. But reinvention carried political and cultural costs that Japan couldn't reconcile. As the economy stagnated, birth rates fell, the population aged, pension costs soared. Once again, the policies and expectations that worked in an era of growth became burdens in an era of contraction. Japan was not dying, but it was shrinking, slowly, quietly, and inevitably. By the late 2000s, Japan had accepted a new role. not as the world's next superpower, but as a stable, aging, innovation nation content with slow growth. The psychological pivot was subtle, but profound. A country that once believed in limitless expansion now learned to value equilibrium. Yet the shadow of the bubble and the choices that fed it still shapes Japan's future. To the outside world, Japan's fall was a cautionary tale about asset bubbles, about overheated markets, bad loans, or central bank mistakes. But the story is deeper. Japan's downfall was psychological as much as economic. The belief in guaranteed stability, the reluctance to confront failure, the cultural resistance to disruption, and the conviction that a system that once worked always would. These forces built the miracle and quietly planted the seeds of its collapse. Japan achieved something extraordinary. 3 decades of explosive growth, full employment, technological mastery, and rising living standards. But by suppressing risk, it suppressed evolution. By avoiding short term pain, it delayed necessary adaptation. And by prioritizing harmony, it made frank acknowledgement of mistakes nearly impossible. The collapse wasn't a sudden explosion, it was the slow fading of a system that had reached its limits. Today, Japan is still one of the world's largest economies, still a leader in robotics, automotive engineering, and design, still a nation admired for stability, safety, and innovation. The miracle did not disappear, it simply changed form. But the psychological scars remain, visible in the caution of investors, the conservatism of banks, and the reluctance to take bold risks. Every economic miracle is built on a story, a collective belief about who we are and what the future will bring. Japan's story was discipline, unity, and unbroken progress. And for a time, it created one of the greatest economic transformations in history. But when belief becomes certainty, when confidence becomes dogma, and when stability becomes the end rather than the means, even a miracle can fracture. Japan didn't fall because it was weak. It fell because it was strong, and believed that strength would last forever. And in that quiet paradox lies the true legacy of Japan's economic miracle.